Something just snapped in silver, and if you blinked, you missed it. We're talking about a collapse from roughly $121 down to the low 70s in a matter of days, and then, almost immediately, a violent rebound back near $90 an ounce in Western spot markets, up almost 12% in a single trading day. That literally just happened, and here's the wild part. While everyone was panicking in the West, Shanghai barely flinched. Physical prices over there held closer to $95 to $100. Both physical dealers and macro desks are now saying the same thing. This wasn't a demand crash, this was something else entirely. Stay with me, because I'm going to show you exactly what caused this move, why it matters right now, and more importantly, how to recognize this pattern the next time it shows up in any leverage market you're watching. Before I explain what actually caused this crash and snapback, let me teach you something that most people fundamentally don't understand about markets like silver. Price isn't just about value. It's not even mostly about value in the short term. It's about pressure, leverage, margin requirements, and forced behavior move prices faster and harder than fundamentals ever could. Think of it like a crowded theater. Everything's calm, people are watching the show, but then someone yells fire. Suddenly it's not about who wants to leave anymore. It's about who has to leave. The exits get jammed, people push, panic feeds on itself. In commodities, when margin requirements jump, traders don't sit there asking themselves whether silver is fundamentally cheap or expensive at $70. They don't care. They sell because they're being told to sell. Their broker is calling. Their account is underwater. They have no choice. And here's what happens next. When that forced pressure lifts, when the exits clear, price doesn't gently recover like water finding its level. It snaps back, hard, fast, violently. If you've ever wondered why metals can feel absolutely dead for months, just grinding sideways, and then suddenly go vertical in a matter of days or even hours, this is why. Pressure builds invisibly under the surface. You can't see it on a price chart. And then it releases all at once. The move looks crazy on a candlestick chart, but the mechanics are perfectly logical once you understand what's happening beneath the price action. So what does that tell us? It tells us that short-term volatility in leverage markets is often about structure, not story. It's about who's forced to do what, not what the fundamentals are telling you. And if you can learn to recognize when forced selling is happening versus real selling, when mechanical moves are happening versus fundamental shifts, you'll be ahead of 90% of people watching the same charts. If this is making sense so far, drop a comment below and let me know. I want to hear what you're seeing in your own markets. Now here's what's actually happening under the hood with silver right now. The primary driver of last week's crash wasn't a breakdown in physical demand. It wasn't some sudden loss of faith in precious metals. It wasn't even about the dollar or yields or any of the macro narratives people were throwing around. It was leverage getting wrung out of the system. The CME, that's the Chicago Mercantile Exchange, where silver futures trade, they hiked margin requirements. And when they do that, it forces liquidations. Here's how the cascade works. Paper longs, these are traders holding futures contracts. They suddenly need more cash in their accounts to maintain their positions. If they don't have it, they have to sell. So they start selling into a market that's already falling. That pushes the price down even faster, which triggers more margin calls for other traders, which forces even more selling. It's a feedback loop, a liquidation spiral. And it doesn't stop until either the selling exhausts itself or prices fall far enough that buyers step in hard enough to absorb everything. That's the mechanical part. But here's the confirmation piece that tells you this wasn't about fundamentals. Physical markets didn't follow the paper crash. Shanghai prices stayed elevated. Premiums on physical metal, those didn't collapse the way they would if real demand was evaporating. Dealers kept moving metal, real silver, the stuff you can hold in your hand, that kept trading at higher prices than what the paper market was showing. That divergence matters. When paper prices disconnect from physical reality, they don't stay disconnected for long. Why? Because someone's going to arbitrage it. If paper silver is trading at 75 and physical is moving at 90, someone's going to buy the paper, take delivery, and sell the physical. That process forces the prices back together. So once the forced selling eased, once margin pressure started to fade, shorts rushed to cover their positions. They're looking at that gap between paper and physical and thinking this thing's going to snap back hard. And they were right. Paper prices had to realign upward. That's why you got a near 12% rip in a single session. But here's the part that should make you nervous if you're short, or excited if you're positioned long. This kind of snapback often isn't the end of the move. It's the reset before the next leg higher. Now let me show you what very few people are actually talking about right now. The timing of these margin hikes isn't random. They tend to happen when volatility spikes or when positions get too crowded on one side. The exchange is trying to protect itself from counterparty risk. That's fine. That's their job. But the effect is that it amplifies moves that are already in motion. If silver's falling and they hike margins, it accelerates the fall. If it's rising and they hike, it can chop the rally. What's interesting here is that the physical market staying firm during a paper liquidation event tells you that the underlying bid for real metal is still there. Industrial users still need it. Stackers are still buying. Asian buyers didn't panic. That's your signal that this was technical, not fundamental. And when technical selling exhausts itself in a market where fundamental demand hasn't changed, you get snapbacks, sharp ones. This is the exact same playbook we saw back in 2011. You remember that year? Silver had an incredible run. It went from under $20 to nearly $50 in a matter of months. Everyone was euphoric. And then the CME stepped in. 5 margin hikes in 9 days. 5. Silver crashed. It dropped from 48 down to 32 in a week. Everyone declared the bull market dead. The financial media said it was over. Traders who bought at the top were wiped out. But then something interesting happened. Price violently rebounded. It didn't just recover some of the losses, it stabilized, built a base, and then made another run that took it back above 40 before the final top came in. Same pattern, margin pressure, forced liquidation, rebound, continuation. The people who understood what was happening mechanically made a fortune on that bounce. The people who were listening to narratives got chopped up. Same thing in March 2020. You remember that? Liquidity vanished across every market. Stocks, bonds, commodities, everything sold off. Silver got hammered. It went from over $18 down to nearly $12 in a matter of days. People were calling it the end of the metals trade. Flight to cash. Dollar king. And what happened? Once the forced selling ended, once the Fed stepped in with liquidity, silver didn't just recover. It redefined the trend. It went from $12 to nearly $30 in less than a year. More than doubled. The people who understood that March 2020 was a liquidity event, not a fundamental breakdown, those were the ones who bought when everyone else was panicking. When you zoom out and look at the pattern across multiple cycles, it becomes really clear. Sharp mechanical sell-offs driven by leverage and margin pressure don't mark tops. They clear the runway. They shake out weak hands. They reset sentiment. And then the move continues. Every time this setup has appeared, where paper markets collapse but physical markets hold firm, the rebound has been fast, aggressive, and confusing for anyone who's watching headlines instead of watching mechanics. The larger story here isn't about any single day's price action. It's about pressure, release, and repricing. Now let me be skeptical for a moment, because I want you to hear independent thinking here, not just hype. Could this just be a dead cat bounce? Absolutely. Markets fake you out all the time. You can get a sharp rally off a low that fails and rolls over into new lows. It happens. Could macro liquidity tighten and cap the upside from here? Yes. If the Fed's not cutting rates, if liquidity conditions are tightening, that can put a ceiling on how high precious metals can run. And here's the thing about all the manipulation claims that people love to throw around. I'm not saying markets are perfectly fair. I'm not saying there's no funny business. But arguing about intent doesn't help you trade or invest. What matters is structure. What matters is understanding the mechanics of how these moves happen, whether someone's pulling strings behind the scenes or not. The cascade is the same either way. So here's what I'd watch for to know if this thesis is breaking down. If silver loses the $85 to $90 zone quickly and can't reclaim it, that's a problem. If it fails to get back to parity with Shanghai prices, somewhere around 95 to 100, that tells you the paper market isn't following physical like it should. And if we lose 70 to 75 again, if we make new lows, the thesis breaks. At that point, you'd have to reassess whether something fundamental changed that we're not seeing yet. So I'm not telling you this is a sure thing. I'm telling you to focus on what you can control. Watch levels, watch behavior, watch for confirmation. Don't fall in love with narratives. There are probably 3 types of people watching this right now. Let me speak to each of you directly. The first type is already long silver. Maybe you bought physical. Maybe you're holding minors or futures, and you got rattled by that drop. You watched your position go underwater fast, and you're wondering whether you should cut and run or hold on. If that's you, here's what I want you to understand. Your job right now isn't to predict that silver's going to 150 by next month. That's not the game. Your job is to watch whether support holds here. Can price stabilize above 85? Does momentum start to rebuild? Are we seeing follow-through on this bounce, or is it fading? If it holds and builds, you're fine. If it breaks, you reassess. But don't let fear make the decision for you. Use levels. The second type watching this is someone who missed the entire move up. You were watching silver at 70, didn't pull the trigger, and now it's back near 90, and you're frustrated. You feel like you missed it. Let me be really honest with you. You don't chase 12% days. You just don't. That's how you get caught buying the top of a relief rally that rolls over. What you do is you wait for structure. You wait for consolidation. You wait for proof that this isn't just a reflex, bounce off oversold conditions. If silver builds a base here, if it holds 90 and then starts making higher lows, then you have something to work with. But rushing in right now because you have FOMO, that's not a strategy. And the third type thinks this is all noise. You don't trade silver, you don't own it, you're just watching because it showed up in your feed. If that's you, let me tell you why this still matters. Even if you never touch silver in your life, understanding forced liquidation cycles will make you better at reading stocks, crypto, anything with leverage. Different assets, same mechanics. When you see a sharp sell-off that doesn't match the fundamental story, ask yourself if it could be structural. Ask if margin pressure is forcing selling. Ask if physical demand or real usage is breaking down or holding firm. That framework applies everywhere. That's the universal principle here. Learn to see through the noise and read what the market structure is actually telling you. So here's what I want you to answer in the comments. Which type are you? Are you holding and trying to figure out your next move? Are you waiting for an entry? Or are you just here to learn the pattern? Let me know, because I read these and it helps me understand what kind of content serves you best. Here's where I stand personally. I'm not euphoric and I'm not dismissive. I'm focused. Let me tell you exactly what I'm watching right now. First, I'm watching whether 85 to 90 holds as a launch zone. If price can consolidate in that range and then break higher, that tells me the bid is real, and this wasn't just a short squeeze that's already done. Second, I'm watching for a clean reclaim of $95 to $100. Why? Because that's where Shanghai was holding. If Western paper prices can get back to parity with physical markets in Asia, that confirms the realignment is happening. It tells me the paper market is falling back in line with reality. Third, I'm monitoring 70 to 75 as the invalidation level. If we go back down there, something's wrong with the read. Either demand is softer than I thought, or there's a macro shift happening that changes the game. Based on everything I'm seeing, this drop was mechanical, not emotional. It was driven by margin pressure and forced liquidation, not by a collapse in fundamental demand. Physical demand never broke. Dealers kept moving metal. Shanghai didn't panic. That tells me the underlying bid is intact. Now, if history rhymes, and if pressure continues to unwind the way it has in past cycles, silver doesn't just bounce back to where it was. It surprises. It overshoots, because once the weak hands are out, once the forced sellers are gone, there's less supply to absorb buying pressure. And if that happens, the move that follows can be bigger than what most people are expecting. I'm not predicting it. I'm watching for it. Let me be very clear about something. I'm not a financial advisor. This is not financial advice. Everything I'm sharing here is my own analysis and opinion. You need to do your own research. You need to make your own decisions based on your own situation, your own risk tolerance, your own goals. Don't take what I say and just run with it. Verify it, challenge it, think critically about whether it makes sense for you. If you made it this far, you're the kind of person who actually wants to understand markets, not just get handed hot takes and price predictions. That mentality will serve you incredibly well. Most people want to be told what to do. You're here trying to learn how to think. That's the difference between someone who gets lucky once and someone who builds real skill over time. If you found value in this breakdown, share it with someone who's trying to make sense of what just happened in silver. Hit that subscribe button if you want more analysis like this, where we break down the mechanics instead of just reacting to headlines. And stay tuned, because I'll be watching these levels closely and updating you as this unfolds. Think independently. Verify your data. Watch the structure, not just the story, and make your own calls. Stay sharp out there.